No major announcement has been made at a Jackson Hole Fed conference since 2010 when Bernanke made a big statement. And it's not like we haven't been hearing from FOMC members and Fed regional presidents ad nauseum in the run-up to this Jackson Hole Fed conference. So I don't think we'll get any major changes that are signaled to us. That being said, I think Steve is right. The official topic is, changes in market structure and the impact on monetary policy. I think officially, they'll be talking about, shifts to passive investment, what that means for liquidity in a downturn, and things like that. But around the water cooler or the fishing hole, I think there will be a lot of talk about the yield curve as well. There will probably be a lot of talk about tariffs. And while the Fed will never comment about the currency publicly, I think there will be talk about strengthening U.S. dollar, tightening financial conditions, and what that means across the EM space in particular.
If they look, and I'm not saying the Fed necessarily always looks ahead, because sometimes I think they've, in recent years, they've sort of not, been sort of looking behind. But if they were to listen to Deere, which said they got input costs that are up, and they can't, their logistics are compromised by how hard it is to get a truck to go where they want to go, and there's more jobs than there are people to fill the jobs, and wages are going. I mean, there's a lot of things that seem to indicate a little bit of the beginnings of a sea change for what we've seen over the past at least 10, 15 years. Do you think they're aware of these things and will change anything based on that?
They're definitely aware, and you're right that input costs and transport costs in particular have gone up. But for all of the inflationary forces we have in the economy, there are a bunch of disinflationary forces as well that include things like the gig economy and the fact that we're adding most of our jobs in services-producing sectors. We're withdrawing monetary accommodation, which is a huge negative side demand shock on the U.S. economy. That all puts downward pressure on prices, which is counteracting some of the inflationary pressures. So there is a never-ending conversation at the Fed about what's happening with inflation. It's looked quite a lot better over the past couple of months, but that's mainly because of statistical quirks, things dropping out of the year-on-year comparison, more than anything structurally changing. And I think the Fed is aware of that, too. So that will certainly be part of the conversation that always is at the Fed. But I'm not convinced that we're on the precipice of a sea change in terms of inflation. I still think there are a lot of disinflationary forces in the economy.
Oh, you don't?
I have a question I was told not to ask you. What do you think I should do?
I typically don't listen, but...
You don't listen? I'm not going to listen either, because I really have a question I want to ask.
I think in this case,
Megan.
It's a pretty good idea.
Megan, there's going to be central bankers that are going to be sitting next to each other. The German guy is going to be there with a 10-year yield, 250 basis points different from the American guy. Is your forecast here that these things come together, or do they remain far apart? And just give me a 30-second answer if you could.
So I think they'll remain pretty far apart until the ECB starts hiking rates, which probably won't happen until next year at some point. Even further down the line, if Turkey turns into a wider emerging market debt crisis with contagion to the Eurozone. So I think, the 10-year yield will remain pretty low. I don't have it going up to 4 and over the 5-year forecast period, but I think German bunds will be pretty low until the ECB finally gets out of negative rates.